Hi, this is Randy Finney with Right Side of the Chart, and this is a pre-market update for Friday, September 23rd, 2022. I usually don't do those in video. I got out post to you what I think is most relevant today, and I just wanted to expand on that. Again, you have the charts. One thing, let me just knock it off so I don't have to get to it later. That NG trade, told you just recently we had finally took out that 750 level, and like I said, it was a big support level. So this is, you can see we have the largest red candle. This is the daily chart in some time, and let me show you a zoomed in version of that bear flag. This I picked up on last night. You had this bear flag continuation pattern right there and playing out in textbook fashion. That's actually drew it like that last night. So there's the breakdown. It's impulsive. The measured target's right here, but I have to jump out to 3 months. That's why, like I said in the chart, I did got out to you today. I had to move out there to get the pricing down here and show you. That measured target, by the way, is just that flagpole, the impulsive leg down leading up to the flag, and then you put the flagpole right at the top, the highest point of the flag, and that's takes you about 661 measured target, and this is why I love technical analysis. It never fails to amaze me how often these patterns, measured targets for various technical patterns measure out to where I was already targeting anyway. So we'll see if it plays out in that fashion. But what I can tell you is, whether it does or doesn't, we took out 750, and as of now, that was big support. Any kick back to it would offer an objective reentry. I don't think we'll get it. I think there was, natural gas hits that point where it starts to fall. And by the way, that is and remains and has been since way up here my final target on this as a swing or trend trade. But we could easily shoot through there. The nature of natural gas. There's the next. Let me just give you that level. And one of the things too that's as I say, I try not to be a fear monger, but we're at with each tick higher in the Treasury markets and each tick higher in the U.S. dollar, we are at an increasing risk of a major, systemic event or something breaking in the global financial system. I'm not talking about Armageddon, doom and gloom, but something big, a bank or financial institution or big fund, or just a domino effect of selling begets more selling, and sometimes they don't even know. That's what I remember in fourth quarter 18. We called that correction to the penny, ran it down hard, and I remember the bobbleheads on TV. They had no idea. They were trying to cite a reason, because that's what the press always does. The financial media, their job is to, anytime the market makes a big move, a daily move up or down or a trend, they always will assign a cause to it, and sometimes the causes are laughable. Quite often, makes sense what they're assigning to, but back then they didn't know. And so sometimes you just get that selling, and without any clear catalyst other than just more sellers and buyers, and that's it. So anywho, I wanted to update you there. That one looks good, and I just, like I said, if we smash through there, where I'm going with this, I'm sorry, I went off on a little tangent there. Should things break soon, like I said, you're seeing some drastic moves. You saw just yesterday. Remember, for the first time in, what was it, 22 years, the Bank of Japan intervening in the currency markets to try to prop the yen up. And then just today, the UK announced the biggest tax cut since, I'm sorry, the headline, I think the 70s, if I'm not mistaken. Huge event, and they're trying to, stop the fall of the pound, and that didn't help. And it's so right in front of your eyes, you're seeing these huge drastic steps being taken, and yet we're still in this orderly drop. I've been talking about that for a while, and that's why there's no signs of a bottom yet. In fact, we haven't even entered that phase of panic type selling. So I want to just loop back. That loops me into something here. Okay, right or wrong, I threw out my Fed pivot idea. I've even going back way back, back in 2018, I called for a major pivot in the Fed and nailed it right before they did it, saying that was when they had first tried to take away the juice, the easy money by raising rates back in 2018, and then as predicted, the market threw a hissy fit, and as predicted, the Fed came right in and gave the screaming child, the screaming brat, what it wanted. I mean, it gave the market turned around and started cutting rates again, taking back the hikes that they tried to instill. Anyway, Mike Flagel asked if a longer term wouldn't a pivot show the market they've lost control. Well, here's my thoughts. And look, this is very micro calls. I'm trying to meld technical analysis with fundamental analysis, and these may play out or not. But some of my reply is I think everyone knows, at least the smart money knows, professional and institutional traders, that the Fed has no idea what they're doing. I've been a big critic of the Fed for a while. That's obviously no secret. I'm a little surprised at just how unwaveringly hawkish Powell's been. It's odd. Instead of just saying what he needs to say, he's coming across as unyielding. He's unwilling to budge on quantitative tightening. I'm sorry, and that's where I think it'll come in. He's certainly not going to. I wanted to be very clear, and I added that to the other comment I made, the post I made earlier today, previously, about I do not expect the Fed to cut rates. Don't get me wrong. They're not going to touch the federal funds rate, but my suspicions, and again, we didn't get it during the FOMC meeting when Powell spoke, but I think if anything, there'll be hints or maybe explicitly or at least implicitly that they're going to pause or temporarily, I'll put in parentheses, temporarily pause the rate of quantitative tightening, because again, like I said, it's just you cannot. These rates are unsustainable. The economy, and not just in the U.S., global economy will break if we continue to see Treasuries rise at the rate that they've been rising. So so far we've absorbed it. But now you're talking what, where do mortgages go to 7, 8%? That will outright crash the housing market. It's unsustainable, in other words. So maybe we can level off where we are. I think a best case scenario, but again, to continue at the rate of ascent, and you can just look at Treasury yields, 30-year yields, 10-year yields. That is unsustainable. And from those sharp moves usually come sharp reversals. And I'm already seeing one in pre-market today. I think we may have gotten that bottom may be here in the Treasury bonds. I'll get to that in 1 second. So anyway, what else I say here? If nothing else, should my hunches prove correct and the Fed makes even the slightest hint of backpedaling, especially so close, right on the heels of this week's FOMC meeting, you talk about a loss of confidence. Imagine, again, he didn't just come out and say what he needed to say. We were raising 3/4 point. He made it just so clear that they were, not even considering. And the question was asked by a reporter, brought up how mortgage rates are shooting up so high, and it shot over 6%. And he made it very clear that they're not even considering reducing the quantitative tightening on the mortgage-backed bonds. Selling off they're reducing their holdings in the MBS, mortgage-backed securities. So that's where and I went on to say too, is he may, I don't know if the Fed has to disclose if they modify the quantitative tightening in advance. They've been I don't know, that kind of morphed over the last decade, where the Fed has gotten just so darn transparent. They're afraid to spook the market, and they tell everyone everything they're going to do instead of just doing it. So I don't know if they'll communicate that right away, or I suspect if they don't, they'll go in and maybe secretly support the bond market, and then maybe you'll find out in hindsight that they were. I don't know again what their obligations are. They've been so upfront in communicating every single thing they do to the markets because they didn't want to shock the stock market for quite a while now. And so it would be a little atypical to see them go in and let's say cut back on the quantitative tightening as planned, as what they said they would do. I don't know. Anyway, that's one thing that's out there. And So that's it. So whatever I said, lots of moving parts. Take it with a grain of salt. I'm just telling you what I think may happen, and more importantly, how to react to it. Because here's what I think would happen if it is, and if assuming it comes from the Fed. Let's just could come from any aspect. There's other central banks making some extreme moves, as I mentioned out there. We'll see what happens, but. So let's just say that does happen, and Powell or the Fed, or even through one of his mouthpieces, one of the other Fed governors. I think there's another governor talking today in addition to Powell. I think it'd be a massive blow of confidence if the Fed were to backpedal again, so close to the heels, because they should have said anything that they were considering 2 days ago. On Wednesday when he spoke. So I think that would be a net bearish event for the stock market. A massive loss of confidence in the Fed, who's already pretty much lost the confidence of the general public. I think that's clear to everybody again, putting us where we are right now. We are there, make no mistake about it. Largely, not exclusively, Washington played a very big part in that too, overstimulating the economy. But the Fed, I think everyone agrees, caused this inflation. Anywho, and so here's what I said. I think that would be a net bearish event for the stock market. That means longer term bearish, more downside. However, after a likely knee-jerk bullish reaction, so your stock market could explode, and most likely would explode higher on any even the slightest hint of a pivot by the Fed. Okay, so just keep that in mind. And so, what's the takeaway on that? Well, that's a rally to be faded. Am I covering shorts in advance of that? No, but you might not want to, be crazy heavily short, if that happens. And if it does happen, recognize what it is, and I'll try to give you my thoughts as to how far any surprise, short covering rally may carry. We'll see. And again, it hasn't even happened yet. These are just ifs, and this is part of a trading plan. So be aware of these things. If you hear of that, if that headline hits, like I said, Treasury bonds will explode, in my opinion, especially the long bond. I told you the other day, I dumped all my short-term bonds because they're not going to pivot on the federal funds rate, and that's going to more closely affect the 5-year bond than the 10 or especially the 30-year bond. It's the 30-year that will most likely rally the hardest. So that's it. And then like I said, I don't know if they have to publicly announce if they're going to support the Treasury market or not, but I suspect they will at this point. That is now going to become a concern and maybe even a priority for the Fed. We'll see. But, then again, nothing surprises me. I honestly, I think it's scary. I think Powell being in the position, probably considered, a lot of people consider that the world's most powerful man, Jerome Powell, more so than President of the United States or anyone else. All right, back to the charts. Enough of my rambling. You want to know where the opportunities are to make money. USO and crude. I already gave you the update on natural gas, and recently I gave you the update on crude. I'm still bearish. Still, it's just shrugging off these divergences, just like the stock market. We've had those 6-minute divergences. I'll keep moving the lines, but I'm still holding on to the short, still maintaining that longer term target. And this is pre-market, the white candle. So you can see that crude is poised to gap down. USO is poised to gap down below my final line in the sand level I gave you yesterday at about 67.61. That captures all these previous little spike lows before the previous support range that I had right there. We had a few dips, and now we've taken that out. And it's just one knife through the heart of the bulls after another, and eventually you'll see this. And this also will, remember, crude oil ultimately, or at times, I should say, sometimes there's a disconnect between fundamentals and reality or prices, but it should be priced on the expectation of slowing economic growth. And remember, this is very simple, guys. If nothing else, just remember this, especially at this point in time. Not back in 2019 or 2020 or 2010 or any point in between we're in a bull market. That doesn't matter. Those are just pullbacks in bull markets. But when you're in a bear market like we are now, and especially we're testing the lows. We're going to test those lows today. We already did in pre-market in some of the indexes. every tick lower, every single tick lower increases bearishness. It increases the odds of a recession. We're probably already in one, but then it doesn't matter what I think; it's what the masses think. And so every tick lower in the stock market from this point, especially at new lows, that's what I'm referring to, increases odds, and therefore, the logical assumption is if the economy is heading into recession, even masses may not have believed it before. More and more people believe it. That's going to reduce the future demand for crude oil because less people jumping on planes, going to Disney World, and taking business trips and riding, planes, trains, and automobiles. Everything moves less during a recession, so there's less demand for crude oil. All other things being equal. Yes, there are other factors, but that's it. And look, we can sit there all day long and hash over the fundamentals. Right now, we have a breakdown in crude oil. Let's not overthink it. This is CL 2-year daily chart on the futures. Here's your primary uptrend line right there. There's that key support level. This is a double breakdown. So yes, positive divergence. Yes, if the Fed comes out and does something that sparks the market, that could lead to a false breakdown in crude. And if it does and you recover these levels, it should have no business at this point getting back above there. I allowed that first recovery. I told you I would before it happened, and I stayed short. And at this point in time, it shouldn't happen. We should not get back above much above that 85.70 level. Otherwise, from a technical perspective, that's going to be near-term bullish. It would mean a false breakdown, bear trap, and it would also keep these positive divergences in place and could send oil to new highs. Possible, and that would also be a net negative for the economy. So I really see no way out of this for the stock market. Honestly, it's sort of a double-edged sword or a catch-22 every way you look with commodity prices and interest rates and everything else. And at the end of the day, just take a step back if it's all noise and just too much to process. Just as long as these charts tell me stay short and this is where we're going, at least that's what I'll do. So counter trend rallies will come. With each tick down, the odds increase at the Fed, or somewhat you're going to have some type of shenanigans to try to prop the markets up. But there's just not much right now to convince me to call a bottom on the bear market at this point in time. All right, let me get the video out. That was the opening bell you just heard. So that's it. So still bearish and short crude natural gas, still bearish and short the equity markets, and still bullish. And I'm using those treasuries too. I'm drawing down on ZB, but this is a nice overshoot. That's what I told you I'd get to today. See, here's this 6-month chart, same one I got out to you. There's something I've noticed over the years. I've talked about it not in a while, but on some of my favorite patterns, such as bullish and bearish falling wedges, as well as price channels, descending or ascending. This is a descending channel. There's something I've noticed, a phenomenon, when you get very at the point where it's very long in the tooth. It's apparent. This is a very, very unusual and prolonged price channel. And so it's a downward channel, so you're expecting at some point there's going to be a reversal and an upside rally, and we're going to switch trend. And so just like on these wedges, when you get near the apex of a rising wedge, instead of breaking down, sometimes you overshoot to the top, and I call it a wedge overshoot. And on the bottom, on a bullish falling wedge, you shoot to the bottom and then usually right back in and up and out. So it's a 1-2 punch kind of thing if it's going to happen. So there was an overshoot this morning, and so if we can follow through, again, the buy signal, the safe bet is wait for a breakout above the channel on ZB or TLT if you want to use Treasury bonds, the ETF that is. But I'm also viewing this as a hedge because it's been highly correlated to the stock market. So by being short equities and long treasuries now with room to add, I think the downside right now is limited in treasury bonds, and they tend to fall less. So even though I'm going down, I'm making money on the index shorts, they're going up. And should the Fed come in or something happens and there's a spark that triggers an explosive short covering rally, this should go up and help offset any losses in my equities. until I decide whether to, what I'll probably do, like I said, is short into a rally if we get one, if there's any shenanigans and there's any type of intervention in the market to prop it up. Like I said, we're not yet close to where I think this market's going to end up, and so I'm viewing, just like in crude and natural gas right now, any bounces should be viewed as an opportunity. A shorting up bounces back into resistance, and that's it. All right, let me get the video out to you guys. We'll end it here, and I'll do updates on gold and the cryptos and everything else. They're also something that I think. Well, again, let me get those in another video and get this one out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.